Welcome to Futures Now. I'm Jackie DeAngelis coming to you live from the commodity desk at CNBC Global Headquarters. Here's what's coming up on the show. The major averages sinking for the third straight day as the S&P is tracking for its worst session since mid-May. And technician Scott Redler says the pain is just getting started. He's going to break down the charts for us. Plus, hedge fund manager Bill Perkins says there's only one area of the energy complex that's about to surge. He's going to tell us what has him so bullish. And later, gold rallying to a 2-month high today, and one of our traders says it's about to soar past 1,300. We're going to tell you how high the yellow metal can go. But we start with the markets first. Jim Murio and Jeff Kilberg are on the floor of the CME in Chicago. Always great to have you both. Jim, let's start with you. What do you make of the recent sell-off? Is this all related to geopolitical tension?
No, you know, and it started with geopolitical tension, and then comes the realization that people have a few too many stocks. If you look at the stock market, it looks like it's the mildest level of panic. But if you look at the gold market, gold's only up $20. So gold is telling you this is just a fairly major concern, not a panic. Now, the stock market, can it go lower? Well, sure. It's crept higher. We didn't have a 5% pullback in, however many years. We've been talking about it forever. So can we have a pullback? Sure we can. But I'm not ready to believe that this is all because of geopolitical tensions. I think it was just kind of primed to go lower.
As you guys said on the air, Jeff, geopolitical problems aside, it's going to take a while for this situation to pan out. It would be a lot for the market to be panicking for this reason alone.
Yes, I think you're right. But we are seeing a couple anxiety levels move higher. Look at the VIX, up about 20% today. Obviously, it was at some very subdued levels, but I think it's a 1-2 punch. And Jimmy's right. We saw that historic move in the Dow Jones, 10 days of positivity, consecutive all-time new highs. And now, all of a sudden, we have the global tensions arising, vols on the move. So I absolutely think it's time for a little bit of breather, and a correction would be healthy. But when you see the NASDAQ, as well as the DAX, as the CAC, when you see all these global indices really in the red today, I think that's telling the people are heading to the exit prior to the weekend, because this war of words from Kim Jong-un as well as President Trump, when President Trump says something, we don't have a lot of historical data, Jimmy. We have 200 days of him being in office.
Right.
But he did what he said he was going to do in Turkey. Is he going to do something this weekend?
Right.
I think the odds are in the favor of yes.
Yeah, that's the question. I mean, he's drawing a line, Jim Murio, and I think that people think he will stick to it more than our previous president.
I'm not so sure about that. And like I said before, the gold market's not so sure about that. Yeah, the VIX is up $4, but the VIX was from $9. So the market's telling me that it could just be words. And yes, we saw some action.
You don't think he's going to follow through?
No, I'm not saying that he's not going to follow through. But I'm saying that he is someone who likes to negotiate as well. And he throws things out there and then sometimes comes back. Remember the Turkey thing? He never said much about it. And then all of a sudden missiles were flying.
I always go back to that's how he does. That's how he does the art of the deal. He's very extreme at first, and then he tries to bring the other guy in a little bit. But my problem is who you're negotiating with here.
Right. So that's what I think. The market's going to become used to that tactic. And if nothing happens in the next couple days, we become complacent. We've become numb to things that are far greater than this before.
That's why there's 2,400 level. Technically, it's 2,400 level in the S&P 500. Once the emotion kind of airs out the next day or two, maybe this 2,400 level is an opportunity to load up again. We've seen it repeatedly, Jackie. It's been a winning recipe.
When I see something like this happen, we've been talking about the markets going higher for weeks now, and we keep hitting these new all-time highs. You guys have both said, well, the fundamentals are getting better. So why does something like this spook everybody when potentially conflict is probably far down the line? Jim.
Because complacency had set in. Do you agree?
I do. I think it's more of just a wake-up call, Jackie. People are finally looking at their portfolios. Wow, since November, my portfolio's up 25%. Maybe it's time to book some of those winners and figure out what to do moving forward. We saw a lot of outflows of retails out of the stock market into the bond fund. The month of July was like $17 billion came out of the stock market into fixed income. Very telling.
Is some of this just August, doldrums, people going on vacation as well, like you said, booking some of those profits and saying, we'll get back into things here when we get back in September, Jeff?
Not necessarily. I think a lot of people are moving to the Hamptons for the rest of the summer. But Jimmy and I, we would love to take vacation. We're here. And I think the markets dictate that. And right now, we've been on pause, this low realized volatility environment. We've had all of 2017. We're finally seeing a little bit of elevation. So I think a lot of people are not getting too far from their screens. But let's remember, these screens are being able to be portable. It's all electronic.
Completely. I think this is a question of we just forgetting that risk happens. And
then conditioned to forget.
Right. And then as soon as it happens, I think that, selling can beget selling.
Yeah.
And that's what we've seen happen. And by the way, I'm not 100% convinced that there's a huge downside in this one. I'm going to give a trade in a couple minutes. It could be for a bounce, which I think could happen as well.
Well, and I thank God that the two of you are in Chicago holding down the fort.
Thank you. We're keeping things together here for you. Don't worry. Yeah, appreciate that.
But meantime, for more on the markets, let's bring in T3 Live's Scott Redler. Scott, you see more volatility ahead for stocks at this point. Break down the charts for us in terms of what we can expect here.
Sure, I'd love to. At this point, everyone was talking about on Monday how the VIX was at a historic low. The little move to highs was the lightest volume in like a few years. So then all of a sudden on Tuesday, we had that outside reversal in the S&P cash. That was a signal that potentially we could be at a short-term top. But what you wanted to do is see a little confirmation to that. So if we go to the chart here, the short-term chart of the S&P cash, you see this little topping tail right there on 8.8? That means something to technicians. That means we had to push through and we failed. That was a distribution move versus accumulation on top of all the geopolitical risks. Then here is your 21-day moving average, which is a moving average that traders like to see the market above for momentum. We broke that today, and now here we are on the 50-day. Okay, the 50-day moving average is a key for the intermediate trend. So we might have lost some momentum, but at this point, we haven't been below the 50-day pretty much for the entire year. Okay, so this is a key spot to watch. If we wind up holding it, we might see a little bit of a bounce, but the next time we break below it, you have to be careful, because if you go to the longer term chart, you will see that according to many of the guys out there, okay, that are thinking about a 3%, a 5% correction, which you heard on Monday from Gunlock, a 3% correction, if we break this trend, is 2381. Okay, which is not so off key, right? 3% correction with everything going on, and then a 5% correction is 2332. So investors at home should write down this number and this number, and if we break this line, once we revisit there, that would probably be a really good spot to put some longer-term capital to work.
And what do you think the chances are that we do break that critical trend line?
I think the way things are trading now, where you see tech under pressure, you see the small caps basically grinding lower, already below the 50-day, and with all the headlines out there, and historically it's August, we should be in a corrective period anyway. I think it's a high probability. I would say, 75% chance that we break that, and at this point, most traders have already reduced cash, so a reduced risk, so we're looking to actually test some of those levels along the way and welcome it, because volatility is great for traders. We haven't had it in a while, so we'd love to see it stay.
All right, Scott, always great to have you on the show. Thank you so much. We'll see you soon. Have a good weekend.
Thanks for having me.
Meantime, Jim, you mentioned you were trading the S&P for us. So Scott is saying there's downside risk here, and if we break that trend line, it could be a little bit more painful. What are your thoughts?
That's why I underline that this is a stop in. We talk about these on this show. I want to see some strength to indicate that there's going to be a relief bounce. So the high of the last 60-minute bar was about 24.54. If it trades 24.55, I think that's a spot to get long with a target of 24.70 on the upside. If it subsequently trades back below 24.45, and keep that stop is fairly tight, because we are in some dicey ground here, but that would be a spot to wipe yourself out.
I like this from the risk perspective. He's waiting about 7 handles higher. See the market recover. We saw yesterday on the close a 9-handle rally with 3 minutes left for no apparent reason. So Jimmy's approaching the right way. However, I want to put one little sprinkle on your cupcake, Jimmy. Watch NVIDIA after the close. NVIDIA has been the 2017 proxy for the S&P 500. If their earnings are weaker and they go down, this is going to be a tough trading. We stopped out lickety split.
Okay, so the NVIDIA thing you bring up is good, because we go back then to earnings, and earnings have been good, as have revenues. So I'm okay with hanging my hat on that.
All right, as long as you don't get stopped out.
Amen, yeah.
Amen. The sprinkle on the cupcake, NVIDIA, after the close today. We will be watching.
What's that all about?
Well, you're
sprinkle
kind of
on the cupcake.
Sprinkle
on the cupcake?
He's just a... I'm going to stop.
Yeah,
Producers
I think you should.
Stop.
Okay.
Thank you.
Let's get the risk reward on the trade here. Jim is buying the S&P E-mini at 24.55. He's targeting a move to 24.70. Each point in this trade counts for 50. He's risking 500 to make $750. Okay, let's move on to crude oil, briefly touching that $50 mark today. But our next guest has his eye on a different commodity in the energy complex. Bill Perkins is Skylar Capital Management founder and chief investment officer. The Wall Street Journal referred to him as the last cowboy betting on the volatile gas markets. He joins us now from L.A. Bill, welcome.
Thank you. Thank you for having me on.
Great to have you. You know, we had a guest on the other day that was actually saying nat gas could go as low as $2.20 because the market is flooded with supply at this point. So you make the case that it's going higher. Why?
Well, what we have is very large Mexican exports year on year, and we have more and more LNG exports. And the infrastructure isn't coming on fast enough relative to our exports. So we actually have a pretty tight market now. Not tight enough to overcome a very warm winter, but if it's a normal winter to a cold winter, I believe we're going to see much higher prices.
Okay, the issue of the exports is interesting because people debate which way that's going to send pricing. You think it's going to send prices higher because we compete with the global marketplace, global stage?
I think in the short term, what you have is that, you know, the infrastructure, whether it be supply side or demand side, it doesn't match up perfectly. And right now, we have the demand side infrastructure, that being exports, coming on first, and the supply is not yet caught up. I do believe eventually supply will catch up and kind of normalize prices, but for the next 12 to 18 months, I think the market is in a increasingly bullish position.
Okay, Jim Urio, jump in here.
Just switching over to crude for 1 second. We've debated on this show many times has OPEC lost its power to jawbone crude. They've tried twice, failing somewhat both times. Do you expect them a third time to lean in and talk about cutting production?
I think they would have to, but you know, the next marginal producer seems to be the United States of America, and as we get higher and higher prices, we make producers here richer and richer, and there's newer and newer plays that become economical. So it's a little difficult for OPEC to cut and jawbone prices higher. They can, but over time, what you see is more production out of the United States of America, which puts them in a tough spot.
Yeah, we've become the swing producer. Jeff Kilberg, you're going to jump in here.
I want to stick with the crude theme. And one thing we've seen earnings season here, we've seen global earnings as well grow up. Is the demand picture really there, and is that going to help? Because a lot of people are positioned that we can't sustain above 50, but right now it seems like that's the offsides trade. So I'm wondering what your thoughts are on global demand specific to crude oil.
You know, every time I talk crude, I'm talking a little bit out of school. I think, you know, global demand has so many different variables from so many different areas. What's going on in China, the credit situation, India, automobile growth, long-term policies on whether or not people are going to be able to drive gasoline cars or you know, have an effect depending on where you're at in the curve. So I would say short-term fluctuations, I really don't have that much to say. I think over the long term, though, I think we're going to see demand plateau and actually see a tax on crude oil demand via restrictions from automobiles or electric automobiles penetrating the market further, whether it be efficiency or outright elimination of gasoline combustion-fired engines.
Bill, let me bring it back to nat gas for the last question here.
Yes.
What's your target price, say, by the end of the year?
I think during the winter, since we have, you know, monthly roll-offs, I think we're going to see the winter print over $4. We basically mitigate the supply-demand scenario by changing the burn profile, and we basically tell power plants not to burn natural gas by raising the price. And they unfortunately burn coal, which is dirtier, but that's how we keep our supplies in balance. And that's all predicated on a normal to a cooler winter. Normal to cooler. A warmer winter will probably keep prices in the same range bound. Mm-hmm. But as we go further out the curve, I think it's extremely bullish.
Okay, Bill Perkins, thank you so much for joining us. We'll see you again soon.
Thank you very much.
Jeff, trading crude oil on the back of that interview, do you think we go higher from here? We briefly got over 50 today for like a second.
We did, and you certainly see correlation come back to the equity market. But for right now, it seems a position. We talk a lot about positioning. When crude oil was above 53, 54, everyone was the biggest long net interest ever. We came down to 44. So right now, it feels from a short-term perspective that it wants to go back higher. So I want to use a stop-in technique about 10 cents higher, Jackie. I'm going to be a buyer at 48.75. Just looking for $1.50 here. Back above that 50 to 50.25, being mindful of a stop $1 lower at 47.75.
I'm a medium-term bear on oil, and I think it goes back down to 40. Do I have a problem with it peeking its head above $50 one more time, just to remind us that it's very uncomfortable there, like it has the last couple days, couple times?
We probably
that seems okay.
Still have a few more weeks of summer, Jim, right? So, I mean, it's very possible.
No, I understand that. Of course, it's very possible, but I would personally rather be a seller between 50 and 51 for a medium to longer term trade. You're about to say this is futures now, not futures next week, and that's okay. I think it's going to creep up above there one more time, so I'm fine with it.
I will give you the business. He now has medium term outlooks. There's short term, there's long term, and now he has medium term.
Yeah,
wonderful.
sure there is.
But my point is that everyone has talked about how we couldn't get above 48. So now utilizing that 48, which was old resistance, Jackie, now it's supportive here. So that is the idea of this trade. Why are we going higher? Is OPEC going to move us higher? No, but this is all about positioning. And Gunlock, you talked about positioning in the volatility space. Yeah. I'm talking about positioning here in crude.
Jackie and I mostly have been talking about the 50 level. So there's some other guys you're talking about who are talking about 48. But we thought 50 was the key pivot.
Fair enough. Great job, Jackie. Great job, Jimmy.
Who
He's a little pat on the back over here.
Thank you. Right,
But we'll get the risk reward here and move on. Jeff is buying crude oil, $48.75, targeting a move to 50 1/4. Each point accounts for $1,000, so he's risking $1,000 in this trade to make $1,500. Okay, final topic of the day. Let's end with gold hitting a 2-month high today. Jim, trade the yellow metal for us, considering the fact that we're at $12.91 as we speak.
I am currently long gold at $12.90. I think is a spot to get longer. Thank you. In the Dees contract with a target of $13.02 on the upside, a stop back below $12.84. The point of this here is that complacency was absolutely everywhere a week ago. Sometimes when that bell's been rung, you can't unring it, and people could be worried a little bit now and may allocate some money towards gold. Keep in mind the dollar isn't rallying very hard even off these global tensions, perhaps because we're the ones who were embroiled in the middle of the global tension, so people aren't rushing to the dollar. But a weak dollar and global tension, to me, seems like it could be very much of a tailwind for gold.
And I like this, Jackie. I like his levels. I would love this trade if there's a little more reason for tensions to mount, but that's such a hard component for us to really identify. If we do see tensions really mount or missiles actually in the air, then it's just going higher, substantially higher.
I agree.
But you can't sell it here, so that's the point I was trying to get to.
Right, one question about gold, because safe haven-wise, we haven't seen gold really move since we were worried about the debt ceiling in 2011. I mean, that was the last time we saw a massive move. The safe haven trade has kind of dissipated. Anybody?
No, but you can tell when it's back when the dollar, treasuries, and gold all rally at the same time. Jeff,
I'm not the historian, but when's the last time we had a nuclear missile up in the air?
Yeah. So of course.
That changes the component of safe haven trades, Jackie.
Bring up a good
you can see a 1,300 print and a 1,400 print in the same night.
To put a fine point on this, too, the reason I picked 1302, that's kind of coincides with several old highs, because I do agree to go beyond that level is going to need
an event we're talking about.
An event we're talking about, and God forbid, and I think there's a slim possibility. Yes. But then all bets are off, of course.
But I like the way he's respecting the technicals. This is a range-bound precious metal all year long, so he's being very mindful, and I like the stop, which is very tighter than you normally have.
Right, exactly.
But it makes a lot of sense going into this macro environment.
Okay. Guys, final risk reward on this trade. Jim is buying gold, $12.90. He's targeting a move to $13.02. Since each tick in this trade is worth $100, he's risking $600 to make about double that. Okay, that's going to do it for the show. My thanks to Jim and Jeff. And for you out there, if you missed anything, relax. You can head back to the website, futuresnow.cnbc.com. Everything is on demand there for you. And for the latest headlines and a sneak peek of what's coming up on the next show, be sure to sign up for our brand new newsletter at cnbc.com/Futures Now email. You can find the link to that and real-time trade updates on our Twitter account. The handle there is at CNBC Futures Now. Meantime, we'll see you for the next live broadcast Tuesday at 1 p.m. Eastern right here, futuresnow.cnbc.com. Have a great weekend.